Thank you all for coming this morning. We're going to have a captivating conversation. Really excited about it. But before we get started and talk about who we have here on the Fireside chat, we're going to do a little housekeeping. So, welcome and thank you for attending today's session. It's great to see you all here. That's true. Before we delve into our discussion and meet our speakers, Nick has asked me to share a few things about housekeeping. We'd like to engage you in today's discussion, and we'll be using a polling feature in the mobile app. So make sure you guys all download the app, and you're going to be responding early on in the session to these questions. So please, I encourage you, if you haven't already, download the app. The aggregated responses will be on the screen. That'll be very interesting. And again, this is going to be an interactive session where at the end you'll be able to ask our professionals and experts here questions. So make sure you're engaged and you download the app. There's going to be a brief evaluation of today's session, so make sure you use the app to submit your feedback on the topics. And then the session presentations will be downloadable through the app. So it'll be audio recorded, and the presentations that you'll see on the screen will be able to be downloaded. And with that, I'd like to introduce today's panel. So on the screen, you see Frank Small, John Stasinos, and Rich Tinsley. I'm going to go ahead and let the panelists introduce themselves, share a little bit about what they do in their corner in the market, and then we'll get going.
I thought you were going to do that.
I didn't prepare for this part.
I thought you were going to do it.
We can wing it. I mean, guys, this is going to be fun.
I thought you were doing
We'll go.
Okay.
So,
we'll go.
And off we go.
Yeah, so I can try.
No. Go ahead.
We go
Rich,
first?
you want to start?
Yeah, go ahead.
Rich Tinsley. I've been in the post-acute senior housing operating care for 25 years. I focus mostly on home care, hospice, and behavioral health. So probably a little bit differently than most people in the group. I'm mostly non-real estate. I work for and a partner in a company called Stone Ridge Partners, and we do M&A advising work across the country. Probably close 25 to 30 transactions a year.
John Stasinos, and I'm with Syndat Capital Management. I head up the healthcare sector there. Our company is focused in investing in all of the major real estate asset classes, and they've been a pretty heavy source of offshoring Chinese capital into the Western markets, the US, the UK, and Australia, but mainly in the traditional real estate sectors. But they saw a tremendous opportunity and demand from their investors in healthcare, and hence I was lucky enough to be able to head the healthcare sector up with them. Our major investment in the sector is a joint venture with Welltower. It has skilled nursing and senior housing within it. And we're seeking to build critical mass and expand our platform. By way of experience, I was with HCP for 13 and a half years. I worked across the healthcare real estate spectrum. And most recently, I assembled and managed the international platform. So I bring quite a bit of experience in the US space, but also with respect to senior housing and healthcare outside of the US, I'm fairly versed in that as well. So it's a pleasure to be here. Thank you, Ben, for inviting me to be on the panel.
Thank you, Frank.
Frank Small, GMF Capital. We are programmatic co-GP and sponsors in the senior housing healthcare sector. We do real estate-based investing as well as healthcare services. And it's really sort of across the acuity spectrum with more of a focus on needs-based, so skilled, assisted living, memory care, but it does stretch up into more of the senior housing and age-restricted. And it's all real estate, primarily real estate-based, although we do, as I mentioned, a little bit of ancillary and services investing. I've been investing in the sector for 10 or 12 years for a variety of different private equity funds. GMF is a private capital, long dated. We don't have a closed-end fund, so it's sort of pretty flexible in terms of our investment strategies. It's really sort of risk-adjusted returns versus a hard strategy.
So these equity players have been hand-selected, picked for their expert positions in the various elements of the market that we're going to be exploring today, and we're going to have again, captivating conversation. I'm Ben Firestone. I'll be your moderator. I'm a founding partner and managing director at Blueprint Healthcare Real Estate Advisors, and we've been putting deals together for almost 5 years now in the space on the real estate side. So with that, we're going to go ahead and get into the poll questions. So before we do, we are going to cover 4 major topics. We're going to spend some time talking about capital, where it's coming from, obviously various channels here, including what John mentioned, the foreign capital, exciting conversation there. Risk and return objectives. That's really what the investors are fundamentally looking for, and how do we attack the various opportunities in light of the various risks that present themselves in senior care investments. We're going to talk a lot with Rich about real estate versus non-real estate senior care investments. That's one of the major themes that Nick is really looking to get smart on at the Spring Investment Forum. And then we're going to not only challenge you guys as the audience to forecast what's going to happen in the near term and in the long run to the industry, but also we're going to talk with our experts about what they're going to see, what they're anticipating short run and long run in the industry. So there we go. So first, before we jump into that crystal ball side of the poll questions, we're going to talk to you guys. You're going to go on your app and you're going to say what you are. If you don't know where you fit in this one of these selections here, look on your name badge. There's a color on your name badge. It'll help guide you through this question.
So they're actually answering the questions right now as we speak?
Right now, before our eyes, they are answering this question, John. And they're going to submit to that, and then Hayden in the back is going to be aggregating that data, and before we know it...
There we go. Equity investors mostly.
There we go. So we have equity investors primarily here to see the equity players in the Fireside chat. Very exciting.
I did not vote.
We've got
I didn't vote. I didn't participate. I didn't want to skew the statistics. I didn't want to skew the statistics.
Well, it seems like you guys have come to the right place.
Out there. Yeah.
Who else do we got here before we move on?
Developers.
We got some debt guys. Oh, we're adjusting in real time.
What's transaction?
We have no developers. Wow, that's interesting. No developers.
No.
I think you need new contacts.
Oh, okay. All right. What else
We
do we
have
got?
3. Oh,
We got 2.
operators.
Transactional services. We have some people supporting us. Skylar, did you respond? Operator. Okay. Well, you can submit your feedback after via the app or otherwise.
Apparently not by the app.
Yeah, not by the app. Okay.
We have some foreign transaction support services people here too. Richard Long, Christie's right there. There he is, from the UK.
Great, exciting.
His app doesn't work here.
Okay, are we good on question 1? Is anyone still working on question 1? All right, we're going to go on to question number 2. Okay, again, about you guys here today. How do you classify your typical duration in an investment? Transaction folks out there, some of the blueprint folks, and otherwise you'd be less than 1 year. Some of the turnaround investors, private equity investors, we've seen strategies, buy it, fix it, sell it, or recapitalize. That's the shorter term. We have the long-term holders out there, and then in between.
So a lot of private equity, huh? Mm-hmm. And REITs.
And really what we want you to think about today as we shape the
long.
conversation is where we're seeing, and you'll see on the next poll question, the industry going moving forward in the short run and then in the long run. So those of you who are long-term investor-focused business people, it'll be interesting to see how everyone responds to the following questions. Good on this? We got some numbers in? Survey says?
There we go.
Look at that.
They're mostly long, huh?
4 to 10 years, 12, leading all polls.
Yeah.
Interesting stuff. What do you guys think? Where would you vote here as we wait for the tallies to be finalized?
I'm definitely less than a year. We're
wow.
Transactionally focused?
So that's interesting. Yeah, we would be, in the 3 to 10 year category. I think most kind of fund-related investors are in that area.
Yeah, we're probably skewed toward 10 or longer.
Really?
Interesting. Yeah. Well, a lot of what I see you guys both doing is long-term lease, so you think you're in it for the long haul. And
Yeah.
Long-term lease, long-term
We
financing.
got another one. You guys must have converted, John must have converted another one there. It's 4 to 10 years.
Selling strategy. Oh, here we
well,
go.
Look at that. Look alive.
Everybody is kind of in that.
Wake up, audience. I think
Well,
I see Eric Mendelson back there. My eyes aren't bad. How did you respond, Eric?
Eric's already responded.
He's delegated.
Okay.
He delegated.
All right.
15? Yeah, he's long-term.
He's a long-term investor. He's bullish on the
Yeah.
space, obviously.
I'm disappointed that there's actually no fire.
Yeah, well, we asked for that. We can't get everything. We got some fireworks coming
Next
later,
year.
but stay alive. Stay alive. Stay with us. Okay.
We should put a little, like, image of a fire
Yeah.
on the screen.
Yeah.
Yeah, well,
Like a fake.
next year. Okay.
As I look back at Hayden, and Hayden goes, you could just stop talking now.
Okay. All right, question number 3. All right, guys, this is going to need some explanation. Try to keep everything in NICS regulations, which was ideally 4 selections. So stay with me here. This is your short run crystal ball. Look into your crystal ball. 12 months from now, relative to today. Option number 1, Hayden, stay on this one for a while. It's a little complex. I want to make sure everyone's with us before we get the responses. Prices decline or flat, and velocity goes down or stays unchanged, stays flat. So it's a 2-part question. Now, sticking with that model, prices could also stay flat or decline, and we'll see more transaction velocity. A lot of what we're seeing out there, we've seen some recent announcements and a little bit of distress facing the industry. You'd see more velocity and potentially prices not go up. So that would be option 2. Option 3, prices increase and there's less velocity or remains flat relative to today or last year. And then option 4, prices increase and we see more velocity. That would be, I think Beth is back there, but correct me if I'm wrong, that would signal that we're in a bullish market and we continue to go up. More transaction velocity and more prices increasing. So I'm no economist, I lean on Beth, thank you. She's nodding her head. So does everyone understand that or any questions on this before we start to respond? We're going to do it again in the long run, so make sure you understand.
I'd be very interested in seeing what the poll thinks, or what the audience thinks on this one.
Yeah, I mean, this is the predictive analytics out here. The market will speak. What do you think, Rich? Where would you answer this
I'm in
question?
3 or 4. I mean, on my business, non-real estate stuff, so as long as CMS doesn't do anything crazy with reimbursement in the different categories, it's probably going to be 4. There could be a pause while the industry swallows any major changes in reimbursement.
Interesting take.
That's interesting. Yeah, I think it might vary a little bit by asset class if we're talking about the reimbursed space versus more private pay. But I'm going to come out and say I'm a bear. I'm a bear. I'm on number 1. I think there's weakness wherever we look, whether it's in the operating front, whether it's overbuilding, whether it's in the financing side. There's weakness. I think if we then take a step back from the market and look at the macro picture, which is always very hard to handicap, but if you're looking at interest rates, you're looking at general economic activity, you're looking at leadership at the highest levels of our government, there's a loss of confidence. So I am more of the opinion that prices will either stay flat or decline. Transaction velocity will decline. You're already starting to see buyers and sellers. It's very difficult for people to come to terms. Sellers say they're sellers, but they're not. And buyers have very different ideas of where pricing should be.
So John's seeing the bid-ask spread widen a little bit. Survey is going to tell us what? Okay, we got some good feedback here, guys. That's interesting.
That's
pretty evenly distributed. With the leading charge being prices will increase.
So more optimism.
Velocity, optimism. That's great. That's great. Frank, you didn't get a chance to.
I'm in the. I'm probably 2. Because and maybe that's me being hopeful. So Because if transaction velocity picks up, then it's sellers and/or owners, or distress, sort of a little bit more capitulation and sort of acceptance of pricing and market. And so then there's a lot of stuff that's kind of out there that's just not trading.
Yeah.
So hopefully it'll pick up if prices, people are like, okay, well, we've stabilized on pricing. This is kind of where this is the best I'm going to do. I've got pressure. I got to get out, whether it's a external pressure or internal pressure to execute. So that maybe that's just my hope, but I think we'll be in that either there or sort of kind of just trudge along where we've been.
Yeah, it's consistent with what I'm hearing, and to be an optimist, I'd probably answer 4. I think we're all seeing a lot of different headwinds, but the amount of velocity we're seeing as a firm and as a market, we're seeing a lot of capital overcompensating any of those headwinds or challenges. We're seeing prices go up, and we're seeing more and more orders to fill, and hopefully that bid-ask spread it can solve itself. So let's go on to the final poll question, then we'll open it up for a little more conversation. Whoops, wrong device. Okay, same question. 5 years from now, are we optimists? Are we pessimists? Do we think those challenges will affect pricing? Do we think those challenges will affect velocity? So the same question again. Prices down or flat? Velocity less or unchanged? Fair response in 5 years. Number 2 would be prices down, but we're seeing more velocity. Maybe some distress shakes up and we see more restructuring, as we're seeing a little bit of today. Number 3 would be prices are up and we're seeing less velocity. I can't see how that one would be something we'll see in the long run, but interested to see how the audience responds. And then your number 4 would be the bull position, and prices are going up. We're going to see more velocity, and I think Nick's mission statement, you'll see more and more investors and transparent capital entering the space. Any commentary there before we move on?
I'm a long-term bull. So I think 4 long-term, like 5 years. I think it'll be corrugated from now till then, but.
Yeah. Not surprisingly, I agree with that. The fundamentals of this industry have been strong for 15 years, and they continue to get stronger. And I think you're going to see, while I was a bear in terms of the short term, there's also quite a lot of fundraising that's taken place recently in the private equity world that's focused on this market. I think those, at least the funds that I'm familiar with, equity commitments, that speak for over probably $1 billion to $2 billion of capital that's waiting to come into the space. I think it'll be challenging for them to make the move into the space in the short term, but over time they will deploy that money.
Rich,
So the 5-year time horizon, I'm definitely a bull, 4 even more so than I was on 12 months. Once again, I think between that 12-month and 5-year mark is where you're going to see the changes in reimbursement from CMS for home care, hospice, and behavioral health, and there'll be a period in there where you have at least a pause in the transactions, right? I'm not sure valuations change, but I think you'll see transaction volume go down, and then it'll come right back, and the prices will be high. The headwind, the area that I work in is all about reimbursement. It's really kind of still unknown exactly where it's going to fall out.
Mm-hmm. Interesting. All right, let's see what the audience says. Wow.
Oh, interesting.
We're either getting better at the polling feature or we're really interested in this question.
Wow.
So,
Decline.
Decline.
There's a lot more people answering this one.
So the two leading.
The audience is short-term bullish, long-term bearish.
Yeah, I mean, I think you're seeing by that number 2 leading the way, you're seeing people consistently
That's very surprising.
saying that you're going to,
That's very surprising. Yeah.
Interesting
Very
stuff.
surprising.
Interesting stuff, and we got some long-term bulls too. So
People got some loan maturities in the next.
yeah,
5
and
years.
interest rates clearly plays a role too. Which, if you look at the yield curve, I don't know where 5 years sits, but if you look at this as a long-term stylized model, I think it's just an interesting response from the market.
Yeah.
Okay.
I would have thought it'd be heavy 4.
Me too. The audience surprised us.
So that does it for the poll questions.
That is why I'm not.
Thanks
an
to the
economist.
audience here. Round of applause for the audience. Thank you. Thank yourself.
Thanks, guys.
Give yourselves a round.
Okay. Now we're going to spend a few minutes talking about each of these categories. We're going to start with capital, where it's coming from. So we've seen private equity ebb and flow over the years. We've seen REITs really make a splash the last few years, kind of pull back over the last few. And then we've seen this big theme, and I think John would be better than anyone to answer the question, is what are we seeing with foreign capital, particularly China, and how do you predict that to grow or expand, or how are the Chinese investors going to look at U.S. senior care as an investment space?
Yeah, like I said, I mean, I think I can answer that question basically just by the fact that I'm here and I'm working for an organization that is largely makes their investments through Chinese institutional partners. There's an intense appetite. There's a little bit of noise. I mean, you sort of see the media trying to cover what's going on. I can't really say that I'm an expert in the regulatory ins and outs of a lot of the capital, but long term, there is going to be no stop. There'll be no shortage of Chinese capital coming into the marketplace, but global capital, not just, I think it's inaccurate for us to sort of classify it as coming from one region. Globally, people are interested in the space, and you see it coming from the East, and you also see it coming from our own domestic sources. And it also just plays really into not only just return objectives, but also philosophically where people feel it's important. It's almost getting considered like an infrastructure asset class. So and so there's a lot of infrastructure investors that are coming into it as well. So, you know, look, right now there's a little bit of a cloud over what's going on. I will say that our access to capital is unhindered. And over the short to long term, you're just going to see those fundamental market forces drive more global capital into the marketplace.
So John's a smart guy. He spent over a decade at a REIT, a publicly traded REIT. Now he's with this firm that's relying on Chinese capital. Do you think the Chinese are motivated by investing in hard assets in the U.S., or are they really receptive to the baby boomer story over the long run?
They're receptive to just the fundamentals. And so I think initially, if you look at what foreign investors, at least Chinese, invested in, areas that they were very comfortable in. So they did a lot of residential development because in China, I mean, I don't think there's been a country that's developed more housing than China in the past, decade. So you saw, the initial capital flows come into that. And then there was just a general, increase in knowledge, and for the same, they were attracted to the senior housing space for the same reason that our traditional investors sort of started migrating into it about a decade ago, where it was sort of this alternative asset class. And then people saw it as a great place to get higher returns on a risk-adjusted basis. So it's exactly the same story. But there is a little bit of an overlay too, at least with the Chinese story, because senior housing is a burgeoning market domestically in China. And I think there's probably people in the room that even have investments there or have thought about setting up operations or investments there. It really is at the beginning, and nobody's really got it figured out. They know that it's going to be a need. They know that their consumers are wealthy enough to be able to pay for it, but they don't have a form of delivery that makes any sense. So they're looking abroad to familiarize themselves, maybe control operators, and think about ways to kind of make the play in the domestic market.
Does Cindat think about it a little bit as an R&D as well for learning about it here in the U.S., which I think is probably the most advanced in terms of systematizing, formalizing senior housing and healthcare? They learn it, understand it, and then repatriate it back?
From our perspective, from an investment perspective, yes. So understanding where to make the investments, understanding what types of models work well. Because ultimately the market here is global. You're going to see a lot of our capital providers investing in those markets. Not now. It's just not the right time. But over the next 10 years, there's a tremendous amount of growth that will be going on in those domestic markets. So if you've got players that know this market very well, are invested very well in it, they're going to be a little bit more facile at investing in those markets.
It's going to be very interesting to see how that unfolds and evolves. I know our firm's studying foreign capital left and right. Rich, what are you seeing? Are you seeing foreign capital entering your space? Or?
Yeah, so up to about 5 years ago, all the buyers were typically strategic buyers, mostly buying out of free cash flow. So several things have happened up until that point. You've had this what we call skilled business lower its margins because of reimbursement, and the Medicaid and the private pay business have either increased or been steady, but there's been more flow through it. So the equity guys about 5 years ago are starting to get into the space. They've realized it may not be super sexy, but it's 12% business. It looks like it's always going to be around a 12% business. And if you can buy a platform of 20 million in revenue and grow it to 100, you may start in at 6 or 7 times, and you might be able to exit at 10 or 11 times, even without making the business better, just by size. So the last 5 years, I would say that the buyers are 50-50 equity guys versus strategic buyers. You also, and this gets a little bit into risk returns, I won't talk a whole lot right now, but you also see the publicly traded companies on the home care side being rewarded with their stock. 10 years ago, they were trading at 7, 8, 9 times. It was hard for them to pay much more than 4 times for a platform or for any tuck-in. Today, they're trading at 15, 18, 19, 20 times earnings. Look at the stocks of Almost Family, LHC, and see what they're doing. Their stocks have gone through the roof the last 2 or 3 years. So now that they're trading in the high teens, they can pay 7, 8, 9, 10 times for an asset. And you're seeing a lot more capital come in from that way as well. It's caused the equity guys to step up and pay more as well.
That's an interesting trend. It's almost opposite of what's going on in the asset-based businesses.
Yeah,
I find that surprising in a reimbursed space.
So what's interesting about that, the only headwind you're really having in the non-facility based is what's CMS going to do? How crazy does the reimbursement happen? You know, for those who've been in the skilled business or any of the non-real estate business, the last time we had a major payment change was 1997. And we had about 2.5, 3 years of a bloodbath, right? People went out of business. You had bankruptcies. So as long as it's not as bad as 97, you're going to have a period of adjustments to a new payment system, mostly from the rehab changes probably. And that's the one headwind. But all the tailwinds, the provider, the better outcomes typically. It keeps people out of skilled care longer if you receive the care. The person receiving the care likes it because it's in their home, whether it's senior housing or it's their own personal residence. And the payer system likes it because it's lower cost, right? So, and then you have the tsunami of that everybody's aware of people turning 65, 75, 85. And as that gets older and older, right, those people started 10 years ago, and as they turn 75 and 85, that demand just goes up. So it has all the tailwinds. It's the one headwind, and once people realize what CMS is going to do finally, we can talk about predictions there, right? But once you decide what the reimbursement looks like, it's a very advantageous space to be in.
Yeah, that makes sense.
I think it's a growing sector for sure in our greater industry. Frank, you and I were talking last night at one of the cocktail parties. We said you're the contrarian. We want to nickname you the contrarian. You're sitting down with a lot of equity investors, limited and otherwise. How are you selling past any of these headwinds, particularly on the SNF side? I mean, how are you getting that capital excited?
I think where we see opportunity and where I guess myself and the other folks at GMF sort of over their careers, I guess we're trying to take advantage of the perceived risk of CMS, and it's mostly focused on the skilled nursing side. So the perceived risk of the regulatory and CMS and all the things that can happen, I guess from our perspective and our experience, that perceived risk is higher than the actual risk. So we're comfortable. We obviously have the benefit of not having legacy investments that in the skilled space that from 2014, 2015, 2016 entering the market today. So we're able to kind of enter at a bottoming, we believe, I don't know if it's bottom, but bottoming, and hopefully soon to stabilize market and structure our investments at that level. And that seems to resonate. I think people can appreciate whether we're right, whether we're entirely right, whether we're a little bit wrong. But also I think from a perspective of the capital that we talk to, they're looking at it on a 10 or 15 year basis. So if they look at it and with HUD still available and flowing, you got a long-term asset matched with a long-term liability, and the cash flow dynamic is compelling. So even without any benefit from, even if it's just your HUD refinancing takes out your acquisition financing, you're still sitting on the transactions that we're seeing, mid-teens, cash on cash. A lot of private investors, you get the depreciation shield. That's a compelling investment for them from our perspective personally, as well as when we kind of look across the commercial, because they're also looking more broadly, not just in seniors housing and healthcare, they're looking at the commercial real estate landscape entirely, and they look at it and they're like, okay, well, I can buy like-to-like multifamily for a 5.5 cap. You know, financing is liquid and aggressive there as well, but my cash on cash is, you know, so high single digits. All right, I get there's more risk and I accept it, and I'm pricing risk appropriately, but, you know, mid-teens and growing, that's pretty compelling. Have all my money out in 5 years, that's really compelling.
So risk-adjusted arbitrage. Frank's calculating the risks. It's a great segue to our next topic. So without giving away the secret sauce, how do you structure a deal? How do you share the upside and the downside with your investors? How do you mitigate some of those risks? Talk to us about, philosophically, how do you approach those risks and how do you mitigate them?
I think from a downside perspective, fundamentally our capital invests alongside our investors. So the founders, the co-founders of GMF, and the principals all invest alongside of our LPs, personally out of our pocket. So we try to match and just present to them that we're in the same boat you are. So we're highly motivated to structure these as best and oversee and asset manage and you know, to the best of our ability, because we're going to benefit or get hurt shoulder to shoulder. And then again, the benefit of not having a legacy transactions that are a drain on time and effort, where we can kind of approach things and the way if it's in the skilled space, we're doing both triple net leased, PropCo only, but we're also doing OpCo, PropCo, HoldCos. And a lot of it is really just focused on in place and trying to take advantage of like what's there today. We're not underwriting any growth. In some cases, we're actually underwriting a dip in the near term in terms of performance, and then structuring it around that, and then structuring our debt to understand what our business plan is, whether it's a short-term refinance or a longer-term hold, and sort of capitalize it appropriately. If we've got to put a bunch of working capital in up front just so we can ride through what we think is a recapitalization or CapEx, and just trying to be really rational about how we approach it. But a lot of it is really also, the operator, candidly, is just really spending a lot of time with the operator and really understanding, are they the right operator for that asset in that market? And we're, despite doing a lot of business with very large national operators, our downside protection is we have operators both in the portfolio and through relationships that can step in.
We've seen a lot of NIC panels over the years, and it always comes back to the operator. I think it's just fundamentally what any investor or stakeholder is going to be looking at and chasing the operator.
And we have our operators go invest with us as well. So we'll downstream that risk and return.
Even more alignment there. I'm interested particularly, this is actually my favorite question I wanted to ask John in particular. How do you look at, what are the major differences if you're a public REIT looking at yield and risk, and then now in your new vehicle, what are the major differences there? I think that would be an enlightening question for a lot of people that may not know how those nuances may be different.
Yes, so, it's almost like the veil has been lifted in terms of, REITs are, very limited in a lot of the things that they can do. But for the most part, they're looking at making, deploying capital and rewarding others for riding through the risk spectrum. And that's really the job of REITs. That's why they're efficient raisers of capital, and they can come in and pay a very good multiple for whatever it is that they're buying, because they've usually, they're acquiring at the point where somebody's already de-risked the cash flows. And that's fine. So they have a different role in the marketplace. They're limited, but they are very focused in what they do, and if they do it well, they reward everybody in the marketplace for providing very good exits. But in terms of what we do, we're looking at more opportunistic investments, whether those are opportunistic asset classes, and it could be in something non-real estate related, but we're focused in the real estate world, or in development. So we can do things that REITs can't do. We can, we can own operators. We can set up private equity, classic private equity structures where we're coming in, buying a business. It might be an asset-backed business, but making sure that the management team is incentivized correctly with equity that is, subordinated to the common equity, but still, properly incentivized through a real skin in the game. So we do a lot, but at the end of the day, we're doing things that are completely different from what REITs are meant to do. REITs are very important, and REITs are a nice exit, but they're not meant to do what we're doing.
So a deeper value add and opportunistic development, so on and so forth, more patient capital. What kind of a return premium does that business plan in general have? Sorry, can you hear me now? The point I was making was that John's taking more risk, presumably, on paper. He's doing more opportunistic transactions. His capital can be more patient. What kind of a total return premium is he looking for relative to those stabilized yield-driven REITs out there, like his former employer?
Yeah. I mean, look, it varies, of course, but what Frank was talking about in the sector that he's investing in, mid-teen type cash-on-cash returns, over 2 times return of capital, IRRs in the high teens, I'd imagine. And yeah, higher than that.
I'm going to take all that sniff risk.
In the skilled nursing space for sure, and more of the private pay, sector, we're probably looking for cash-on-cash in the high single digits with, returns, IRRs in the kind of mid-teens, 1.5 to 1.8, multiple of money at the end of the investment. So it varies, but if you're looking at a REIT model, I haven't been in the REIT industry for quite a while, but I mean, I think you're talking about cost of capital there, probably, and their stock price is a little bit depressed right now, but they're looking for an unlevered IRR of probably in the 8% range. Don't even probably look at things on a levered basis, so
how do you
it's very different.
Leverage that? I mean, that could be an interesting question. You can't hear me? Hello?
No.
So the
Just
question
project.
is to everybody, how do you look at leverage?
Do you want to go?
Yeah, I think we're max leverage.
Yeah.
A non-recourse max.
So most of these transactions for us are all cash.
Yeah.
So you don't really have a leverage transaction, although a larger operator or a strategic and also the private equity will have a back piece that I typically don't see, we don't get involved in. So cash on cash, no leverage, mid to high teens. Can be higher, obviously, if you leverage it, and if they have their own backing.
Yeah. And leverage is really determined by the market. I mean, we're max leverage, so
most of the
depending on
companies
what we're
that
trying to do.
That are my buyers, the strategic buyers, they don't have the same ability to borrow money against assets, because when you talk to banks, you talk about cash flow, they tend to get a little nervous because I can have a $50 million company, getting loud now. I can have a $50 million company, and literally my balance sheet may look really good until you start looking what's really underneath it, and it's all goodwill, right? What I have as my balance sheet is my relationship with my employer, my employees, my network of staff, right? Because to some degree it's a staffing company, and more importantly, my network of referrals. And then this cash flow that just keeps coming, right? It's really hard for a bank to figure out how they're going to seize on it when they think about the bad parts that could happen to a loan, right? So my cost of lending gets a lot higher for most of my buyers.
And what about the size of the loans in your part of the world? I would imagine the majority of the audience here is real estate based, primarily. I mean, how do they look at LTVs in your
So most of them are still cash deals, right? So they may have a working capital line that they can hit, but when they come as a buyer, it's not contingent on financing. So publicly traded transaction, Addis is just buying a company in New Mexico, a $50 million hospice and home care company. We represented the seller, and it's an all-cash transaction. They may have a working capital line somewhere behind the scenes, but when it comes to the deal, it's all cash. There's no financing contingencies, and they're doing it out of their cash flow and their working capital line that is totally different than an asset-based lender or lending.
So I'd imagine then that would translate into market multiples that translate to premiums relative to real estate returns if there's no leverage.
Right.
So talk to us about, as we kind of move down the list here, talk to us about what market multiples are. We talk about cap rates all the time. Just for everyone's edification here, the market multiple would just be 1 divided by the cap rate, so the inverse. What are you seeing in home care market multiples?
So they can be different by asset class, home care versus hospital, hospice versus behavioral health, but they're all going up. I alluded to this when we talked about capital. Historically, you've seen that 3 to 5 times range as a multiple of EBITDA, adjusted EBITDA. You've seen that go way up. And the reason that was capped at 3 to 5 times, the strategics that were publicly traded were being traded somewhere between 6 and 10 times, right? And they wanted that arbitrage immediately. Their values have now gone 15 plus, right? What their stock's trading on historical EBITDA, 15 to 20 times. Some are even higher. The stocks will take a month break when something bad comes out in news, but they rebound, okay? So we publish a home health index every month on our website, and it's just a stock of 3 publicly traded companies, and it's been a hockey stick for 5, 6, 7 years, right? And that's the valuation. So that's enabled them to come in, and the guy who didn't want to sell because he wasn't willing to sell for 4 times earnings, which is really his paycheck, right? He now can sell for 8 times. And you're just seeing those multiples increase. Hospice is the same thing. If I had inventory, think about my business, if I had more inventory of hospice, I would love it because there's the hottest thing going, right? So people are starting to talk about a $65,000, $70,000, $75,000 per head census multiple. It's crazy, right? And some of these companies don't even have to be profitable. They don't even have to have an EBITDA. And I got buyers willing to pay 50 or 60 times, 50 or 60, 50,000 times the head. This is non-residential hospice, right? The valuations are extremely high, and they keep going higher every month. But there's a reason for that. Hospice, when you start looking at what they do, it's an underserved market. They're a fraction. So most in Medicare, wherever your setting is, 90 some odd percent, whatever the stat is a huge percentage of your Medicare spend, of your hospital cost happens in your last 6 months of life. If you switch those people to hospice, it goes to a fraction of that, a tiny fraction. So the payers love it. The people want in it. When people are educated about what the service is, typically the patient wants it, and it saves the system tons of money. So the thought in the industry is people are going to use it more. Same thing with home health. So not only do our reimbursements are smaller than what everybody else's are, our revenue, but when you look at the penetration of the non-residential care, it's so small, there's going to be an explosion in the number of people going in that type of service along with the return, right? So it's everything is, the demographics are all tailwinds. It's a hard market for someone who doesn't understand it to get in it the first time, because the multiples are not, it's not like you can just walk in and pay to play for a dime, right? You got to get up and walk to the table and know what you're doing with the right operators.
So what other factors in your space influence value? I mean, is it geography based, obviously supply and demand in the local market?
Yeah, so we have CON issues just like the residential guys do. So if you're in a CON state that's got a moratorium, I can sell the license for a few $1 million with no business, right? So it's the same issues there. States reimbursement, Medicaid, private pay, Medicare penetration of Advantage programs, all that goes into the pricing. Obviously, pure Medicare is the highest multiple, and then you can kind of go down from there.
So what you talk about acuity for a second. I mean, you've got these non-medical home care models, and then you've got everything all the way up the acuity ladder. I mean, where are you seeing those multiple slide? Is it similar to seniors housing real estate, where the IL
they're kind of meeting, because our acuity is going up in the skilled side, just like it's going up in the skilled nursing. But margins have already been compacted, and the reimbursements come down from there. So what you're seeing is people are willing to pay up for even the non-skilled Medicaid, because the margins aren't that different, right? You get a Medicaid business that everybody reviews as being stable. We can argue whether that's true or not, right? Yeah. But stable at 12, 13, 14% EBITDA return, or you can pay up a little higher and get a Medicare business that may be in the high teens, where 10 years ago it was in the high 20s. So since that's fallen, the valuations have actually closed. There's still a gap, but they've actually closed, and people, the larger payers are paying more for private pay and Medicaid than they ever paid.
And what kind of margin on a stabilized Medicaid, run-of-the-mill home health company? I mean, what kind of margin are you seeing? In skilled nursing, we're seeing 10 to 20, and that would be rich. But how does that translate to margin?
It's similar. If it's less than 10, it's a very poorly run business. If it's more than 15, it puts a lot of question marks on what exactly
sustainability.
So that 12 to 14, you could have a year or two where you hit 15, but it's not, in my opinion, it's not sustainable.
Where are the hospice margins? Like for, again, the same kind of range, well run.
So right now you don't see a whole lot of them that are doing really well. You do see some.
And, but people are still paying.
But they're betting on the outcome of more people going through that service. So much of the market is nonprofits. So I spend a lot of my time explaining to nonprofits that you can sell. You're having a hard time reaching your mission. Somebody will come in and buy you. Once I make them understand they can sell those assets and use that proceeds for their stuff to become a client, a seller of mine. So those margins should be in the, I would think, 15 to 20 range on the Medicare side.
Wow.
But they're not today across the board.
Right.
And the nonprofits, nothing against nonprofits, they tend not to want to try to
Control costs.
they fulfill their mission.
Yeah.
What do you got? You guys attacking that market at all as an investor? Are you doing any non-real estate based investment in senior care?
Not strategically, no. I mean, not that we wouldn't consider it, but it would be nice to have a, if we were going to go into that, it'd probably be with an experienced sponsor or partner that really knows it well. But we are on the operations and the real estate-based businesses for sure thinking about making investments in some of the, if we're buying a portfolio, make a strategic investment in an operator, definitely.
So there's still, on hospice for a second, there's still some taboos, right? So think about what hospice care is. You're going to a patient, educating them, and saying, please stop using all these expensive drugs. Right. We're going to make you really comfortable for the last 6 months of life, okay? The benefit's 6 months. The average person uses it for 14 days. So think about it. You can extend that from 2 weeks to 6 months, and you can get more people in it. So when Humana's buying Kindred's got the second largest hospice business in the country, second or first largest hospice business in the country. You now have a payer, an insurance provider, that owns a hospice business. So there's a lot of speculation in the market. Will they keep the hospice business? How would you like your payer coming to you?
Yeah, telling you.
And saying, hey, if you move here, okay, and do this treatment, it'll be a more enjoyable 6 months. Knowing in the back of your head, they actually make more money because it's a lot less cost. I'm not trying to say Humana's would do anything wrong, but there's still a taboo in the industry of who should be in the hospice business. Should it be nonprofits? Should they be somebody who is not tied to home health?
You're seeing that though with the accountable care models that are being rolled out right now in the post-acute and the acute space. There's plenty of conflict of interest there. The hospitals are set up to control it. They're setting it up in their favor. Frank, you've got probably some opinions on this too.
Well, I would like to say no conflict, no interest. So we sort of try to stay away from some kind of playing both sides of that at the same time. But it's just, I feel like on the hospice business, that's been the holy grail is we're going to extend length of stay and increase penetration. I feel like that's been the business plan for 10 years.
And it still is, but you have a ton of...
But it hasn't moved.
So it's way cheaper, right? It's just here in the U.S., everybody has that mentality, I want to fight till my last breath.
Sure.
And that's not what hospice is.
Right. Well, I mean, I think, and it's interesting, and we've done some non-real estate investing. We own some dialysis centers. We've backed some operators. We're invested in a supportive living company. So we've done some of that, and for the most part, it's been pretty interesting and compelling. Because of the multiples and the cash flow. And
is it also a risk mitigation strategy for you to have a vertical integration? Is that?
Yes. Yeah. No. I think on the skilled operating side, absolutely. Where we've seeded operators that we want to build that business and have it be a standalone business and succeed in and of itself. but also it gives us a little more comfort to buy buildings in states where they're experienced and expert operators, because if my tenant starts to stumble, I know I've got people who can step in and pick it up without having to, run a process, and I can kind of pull the trigger a little bit quicker. And that's sort of one of our risk mitigants in our leases, where if we're doing new leases, we have the ability to set it up where we don't have to be tortured by a long chow process or transition or a bankruptcy and wait around, where we can pull the ripcord if there's defaults early on.
We're seeing a lot. I think that's one of the themes, certainly in the skilled nursing market, that's driving value. You get a lot of questions on why can someone make money and go so bullish in light of some of the recent bankruptcy announcements. So interesting stuff there. Let's talk a little bit more back to what we're seeing in the future. And then we're going to go reintroduce those poll questions to give you guys another opportunity to respond as the audience. But where are we seeing supply and demand in the short run maybe disequilibrate, if that's a word?
I like
where
it.
Are we seeing,
it is now.
Where are we seeing the pockets of that XY axis, where that graph might be shifting? Give me some of your takes on that. I mean, we all know that demand in large part is coming in the long run. We also know there's a gap between now and 14 and a half years from now, when the first baby boomer turns 88. Where are you seeing that chart go right now?
Frank?
We can talk if you want a primer.
Yeah, I guess the silver tsunami is very slow moving. Yeah. It's sort of my.
Let's take the conversation and look at private pay senior housing for a minute. So we've seen a lot of new supply. Certain markets have oversupply problems affecting occupancy. Where are we seeing demand, and how are we seeing some of that occupancy challenge? How are we seeing that absorption come in? I mean, where are you guys willing to take some lease-up risk and bet on the long run that the industry will prevail?
But I think it goes to what I was saying at the beginning, and I think this is one of the, at least themes that I want to relate to the audience, and actually interested in seeing if some of the other equity providers have the same point of view. There's challenges, in the marketplace, and there's been overbuilding, and there's also kind of older product that doesn't really appeal to even in a market that hasn't been overbuilt. And you also have certain changes in our demographic, and people are healthier. They don't need these types of facilities until much later in their life. And so when we talk about the demographics, you've got kind of the leading edge of the baby boomers in their kind of early to mid 70s. Traditionally, the average age of entry in our product has been in the mid 80s, but that could move too. So, the demand story is strong, but it's not here. It hasn't been here. We've been talking about it for a very long time, and it's getting there, but it's not here. Also, products like what Rich is talking about.
Home health.
Home health. If you look at more regulated markets that, I've trafficked in, like the UK has a pretty heads-up policy in trying to support non-residential based services, because they're much less expensive, trying to keep people out of these facilities for as long as possible. So getting back to my initial point, there's ways, there's buyers out there for assets, but the sellers aren't ready to sell. So you've got these transactions that are kind of close, but they're just not getting there because people haven't come to the realization that, there is somebody who can buy your 20-year-old portfolio. There is somebody who will invest in it. There is somebody that will make it competitive, but they're not going to be buying it at the cap rate that you want to sell it.
So here's a question. Let's look even further into the future. Will there be a baby bust? If so, when? I mean, you talk about absorption and the silver tsunami, but eventually the tide will turn.
The echo
I'm
boomers?
planning on being retired before that happens.
If I'm still working, I've made some serious mistakes.
You'll have had your
I've really done a poor job if I'm still working when the echo boomers are moving into seniors housing.
I would agree.
What do you mean?
Well, someone's going to be without a seat when the music stops.
I do love what I do, but
Yeah.
And then
I like to do it a little less.
last question until we
I'll
accelerate
answer-
the pace a little
Ben,
bit.
I'll answer that
Yeah, go
question.
ahead.
Look, of
Which one? Are we
course
talking about supply and demand
No,
still?
no.
Oh, the
Anything
echo
goes.
boomers?
Anything
silver
goes.
side.
Heat it
Look,
up a little bit.
I think it's just like anything. I mean, this space is just now becoming, it's coming onto the radar of a lot of the smartest people in our country and in the world. You've got technology that we can't even predict that will change the demand profile of this industry. Will certain things always be necessary? Yes, hospitals will always be necessary. Skilled nursing will always be a necessary part of this. Needs-based senior housing will as well. But I think when we're talking about anything other than that, there's some very interesting things that could happen.
All right. Well, let's put everyone's money where their mouth is. We're going to put you guys on the Blueprint hot seat. All right? The Blueprint hot seat. There you go.
Nice.
That's trademark. So, guys, here's what we're going to do. We are going to put these three contestants into a little bit of a game show. We're going to put them on the hot seat. We're going to ask them several rapid-fire questions. Their response is going to be a word or a phrase if we let it.
We need to get much more interesting because we've lost quite a bit of people.
Yeah,
Yeah,
guys,
come on.
we need to look
Don't
alive
leave.
a little
Don't-
bit.
don't
Let's
leave.
give a
It
round of
makes us
applause
feel
for
bad.
our contestants here.
We're in the
Get
home
up,
stretch.
stretch.
We're in the
Yeah,
we
we are
like
in the home
do
stretch.
some like deep knee bends.
Yeah, so stretch it out here. So
Like,
what
even-
we're
look,
going to do.
now people are leaving.
Oh, God. Jeez.
I invited them to stay.
You invited them to
We still
stay,
have 20
them to
minutes.
and
stay.
they left.
This is my opportunity.
You did it.
Okay, so what we're going to do is we're going to go through.
win.
We're going to pose specific questions. We covered a lot today. Specific questions. We're going to go rapid fire. We're going to start with Frank, John, Rich for the following questions. Are we ready? Are we ready?
I'm ready.
contestants?
Let's roll.
All right. 12 months from now, sniff prices on a price per bed will.
Down.
Up.
Down.
Interesting.
Except mine. Those are going to be up.
When in doubt, come to us. We will help that price go up. Blueprint. Price. It's a great question because our next question is sniff cap rates will 12 months from now. Frank.
Up.
Up.
They've been the same for like 40 years,
That's not true.
They have.
except for 2 transactions. Same.
One of which,
which
was in
I
the
was
news
involved in,
last
yeah.
week.
Well,
Rich.
I was a seller on
Same.
one.
That's right. Okay. Now we're going to go to ALIL. Rapid fire here. 12 months from now, ALIL prices per unit will, Frank,
They're going to be up.
up,
Down.
They should be
Down.
down, but they'll be up.
down, up. Okay.
They should be down, but
The
they'll
code
be
to
up.
contract.
They should
Up,
be
up,
down,
down.
but they'll
Should be
be
down,
up.
yeah.
All right.
Come on, we all know they're going to be up.
Now we're going to talk about AL cap rates 12 years from now. I'm sorry, 12 months
12
from now.
years from now.
12
Down.
months. That was a curveball. 12 months from now, ALIL cap rates, seniors housing, private pay. Frank.
Cap rates. Those are going to be down.
Down.
Flat. Excuse me. Flat.
Acceptable answer.
Up.
John.
Flat.
Flat, okay.
Because I think
All right, offsetting
I think the
factors.
demand is going to. I think the capital markets demand, not the fundamental demand. I think the capital market demand is growing for that private pay senior housing, but I think interest rates are going to kind of push against it a little bit because at some point you can't have there's got to be some positive leverage there.
I feel the same way, Frank. I think that you're seeing the cost of capital go up, but I think there's just so much capital, new private equity, domestic, foreign, and otherwise pressing on that space because there's an arbitrage on our commercial real estate asset classes that are not senior housing.
And from what we're seeing from at least some Fannie and Freddie quotes is they're shrinking their spread to kind of hold the all-in debt cost the same, even though rates are up. Even on the long end, 10, 12 year, they're the
for
Fannie,
how long-
Freddie.
how long can they do that and
How
still
long can
make
they
money?
do that before? Right, at some
Yeah,
point.
it's going to spread.
So that's why I think it's like it'll be interesting to watch that dynamic play itself out.
All right, now we're going to start from Rich to John to Frank. 12 months from now, market multiples on non-real estate senior care will
They continue to rise.
Oh my God.
go up. He's promotional. John.
Not that my opinion on this subject matters at all, but I will say they will stay flat. Stay flat.
Okay.
I agree with Rich.
Trust the experts,
Yeah.
guys. Okay. Question number 6. Over the next 5 years, we're going to go out into that crystal ball long run a little bit more. The single biggest challenge facing private pay seniors housing will be
Supply.
supply.
Supply and lack of a lot of well-capitalized, experienced operators.
I think that's a good response, both of those. Rich.
I was going to say something totally different. 5 years might be a little short, but acuity.
Acuity.
People are going to be sicker in every single setting they're in.
I think also staffing.
Staffing.
Particularly with the, what we're seeing, and to some degree, is with, even though there hasn't been any legislative or truly fundamental changes in immigration policy, it's already started to impact that.
Well, let's talk about skilled nursing. Same question. 5 years, over the next 5 years, the single biggest challenge facing SNFs.
Single?
Single.
Single?
You can give me 3 if you want.
Yeah.
Still the lightning round, but 3.
I'd still go with acuity. It's going to be a much more medically complex building than it is today.
My opinion on skilled nursing is it's reimbursement. It'll always be reimbursement as long as we have a deficit issue in this country, as long as we have a debt to GDP ratio where we're at, it'll always be reimbursement.
I think the combination of the reimbursement and the inability to predict beyond like a year or 18 months what that will look like, combined with, staffing today, we need a good recession.
All right. 5 years from now, this question is dedicated to John.
Labor's a lot easier if there's a recession.
5 years from now, foreign capital in U.S. senior care investments, real estate or non-real estate, will be
Much higher.
much higher.
We just saw GIC come in crazy.
Just you
Just
being
through
busy man.
Sindat Capital Management.
That's right.
Individually.
We will
Move the needle.
Okay.
Huge,
The market
huge,
on your
huge.
shoulders.
Back is going to be
Foreign capital.
back is going to be really tired.
Very tired.
Yeah. Oh yeah.
What did you say?
Well, I think we should all take it upon ourselves to travel to exotic places and find more money for the industry. Okay, sticking with a rich-based question, the balance between seniors housing and home care, real estate versus home care, will...
You'll have more home care in senior housing. You'll have more people be...
So you'll be taking away market share from the guys in this room.
No, they'll be helping.
I think, well, it depends on what
Provocative here.
Yeah.
Depends on what area.
Absolutely.
I'm a big believer acuity is going to be pushed down, right? The hospitals are going to discharge their patients to skilled nursing. Skilled nursing is going to discharge or they'll never be admitted into. And then the continuum will change. Instead of going hospital 48-hour or 72-hour stay going down, you're going to go the other direction, right? So people are in their home. You'll get home care and then go to a skilled nursing and then go to a hospital. So I think the whole continuum changes, and I think that the acuity goes down everywhere. So I don't think I take it away. I just think that the type of patients you see are going to be way different, way more acute in those traditional settings.
Oh, you mean like acuity will get pushed down, the acuity spectrum, not acuity per setting will go down. So like the folks in assisted living will be higher.
So I think skilled nursing will no longer be a therapy center.
Yes.
It'll be a nursing center,
I agree with
kind of the way it's named, right? You'll receive your therapy other places.
Yeah, you're starting to see that already in certain markets where the assisted living looks like skilled 10 years ago or 5 years ago.
So you're talking about skilled nursing and home care right now they're still reimbursed by the number of times your therapist goes in to see somebody. I think that's going to change, and it'll be addressed based on how sick somebody is. Okay, you're going to do therapy because they got a hip replacement, but if they had diabetes, heart failure, and you're going to make more money because you're going to provide more nursing care. It's not going to be I saw somebody for 720 minutes or I saw them 15 times at home. That's no longer. You're not going to have someone's job managing those minutes or visits. It's going to be that piece of it's going to be a cost center, and the revenue is going to be based upon this person's really ill. They need more nursing care, just like a hospital gets reimbursed today.
So then here's an interesting question. Maybe we can ask people. So in that, let's go down that thread and that path where the acuity sort of starts to bifurcate. Independent living. Does independent living do better because the home care can be delivered there, or is independent living at risk because people are going to go from their home and they're just going to they're going to skip over and go right to AL?
I think it helps independent living, but
I want to know what can we do a quick poll? If you think IL's hurt by that trend, you raise your hand.
Let me tell you one interesting thing. I have clients
Most
in
people
both
think
groups.
it's helped, right? Helped by that trend of more expanded home care? Interesting.
I think it helps.
The audience is still
but
with us.
I have two different camps of clients that are in
I think
IL.
that's an interesting
I have
challenge.
one
Like,
that says,
very interesting.
I'm full. I want my IL to be vibrant.
Yeah.
And by the way, when you start getting people who need home health or non-medical care, if some of them have rules already, if you receive it for 100 days, they kick you out because they don't want you to be homebound, right?
Yeah.
And they try to find, most of those though have another setting to send you to, right?
Sure. Right,
Then
yeah,
you
they've
also-
set that up to send you to their assisted
Exactly.
living.
So then I also have clients that call me and say, I need to find out how to do non-skilled and skilled because I need my census to stay up. I need these people to stay here for, it's different ways you look at it. But what that IL is going to start looking like is more assisted living. Because even though the IL is not providing that care, somebody else is.
We have any regulators in the room?
All right, 2 more questions in the lightning round, and then it's time for the audience Q&A to put the panelists here on the hot seat. So 2 more questions. 5 years from now, this is a question near and dear to my heart and Frank's. Publicly traded SNF operators will be.
Gone.
Let's start with Rich.
Less of them.
Yeah, there'll be less.
Gone.
But they'll be. I think there'll be less, but they'll be more
No,
financially
not
stable.
meaning they're just not going to be publicly traded.
Interesting take on it.
I think
The operator shouldn't be public.
We've
I
seen
think
that
what
go
just
in and out of
happened-
favor over
Well,
the
I
years.
think what just happened with HCR Manor Care is going to create an entity that might be.
There's a question.
Yeah, I don't know.
private
Yeah, I
equity.
mean,
Yeah,
I think I
is it gonna
understand
be a
that.
publicly
Do
traded
they
or-
lose their REIT status?
Yes.
Yeah.
Is the question for operators or
But I
the
think
real
it's,
estate
but
owners?
still, that, sorry.
This is for operators?
Yeah, operator. Yeah. Okay, last question, guys, and we'll open up to Q&A. Over the next 10 years, the single biggest change to our industry in totality will be. This is where you got to get real deep.
10 years?
10 years.
Can I
Single
do, I'm going to
biggest
say
challenge.
something really broad because it'll
Broad,
protect
it's acceptable. It's
technology,
lightning round.
the technology
Technology.
influence over delivery of care.
Yeah.
I don't know what that
Frank,
means.
I got to go.
I don't know
with
what
you
that
on one,
means.
but-
Like I have no. I wish I knew because then I'd go be a VC.
Yeah, Frank, I agree with what you're saying. But
I think technology changes it, right? I mean, you just look at,
gotta
I
be.
want to change the topic, but autonomous cars, seniors aren't locked in anymore.
Interesting stuff.
So your seniors are going to be mobile. I believe you're going to have senior entertainment centers for people in their 90s because their sons don't have to take away their keys. They can just Uber it.
Wow.
And it's a totally different landscape of senior housing and senior.
actually,
They can hang out with the millennials.
You know what? I'm gonna
Hang out with the millennials.
Change. Go
give you-
back. You're gonna
no, I'm not
rescind.
going to change. I think technology will definitely affect it, but you got to give something a little bit more specific.
The rules?
Affordability.
Affordability.
Affordability is
Hot
going.
topic.
Affordability will change a lot of this industry and combat some of the demand drivers that are actually not as favorable. If you can provide and build a product that actually is affordable for the baby boomers, that's going to be a huge deal. And always going back to my overall philosophy, affinity groups, affordability and affinity groups, actually finding settings that people want to be in, which I don't think we've done except at the very high end.
All right, final word, Rich.
This is maybe me being an optimist and me liking capitalism. I hope 10 years from now, we're way closer to that healthcare is delivered in a system that's more the better service I provide, the better outcomes I provide, I make money. Not about the more service I provide, the more money I make, right? So that's a huge shift from where we are, and I don't know if we'll ever get to where I'd like for it to be, but I'd like to wake up every morning knowing if I did a great job and I did better outcomes than somebody else, I'd make more money regardless of how many PT visits I made or regardless of all the cost systems in there.
Closing remarks, Frank, John.
No.
We're good.
No, great.
All right. Well, interesting time in our space. We're seeing a little bit of distress and headwinds. We're seeing a lot of capital and a lot of optimism, in my mind. Seniors housing, real estate, and non-real estate alike. And just want to thank our panelists again for their participation and
Thank you.
expertise,
Thank you.
willing to share. We got about 5 minutes left. We're going to open it up for Q&A. Debbie, I think we have a question here in the front. Feel free to target any of our hot seat panelists.
Yeah, I was going to go for the really smart guy.
That's Frank.
You know, the home health. We missed the first 20 minutes, so forgive us if you already answered
That's
the
where
question.
I said all my brilliant stuff.
How does your payer breakdown look?
I'm not a provider. I'm an MA advisor. So we do about 25 to 30 transactions a year. So we do work in private, non-skilled and skilled both Medicare, Medicaid.
So you wouldn't be able to quote the payer breakdown for home health care in general?
You mean globally?
Nationwide, Medicaid,
The
Medicare,
non-skilled's growing.
private insurance,
I wouldn't know.
cash.
I wouldn't know it off the top of my head. No.
Thank you.
Frank, would you?
No.
Okay.
No.
I think Giancarlo has a question over there.
The non-skilled and the private pay are definitely faster growing than
Definitely did not
Medicare.
give it to
Medicare is
Siegel.
shrinking
Look at
because of
Siegel. I
the
see Siegel.
episodic time frames. I mean, it's acute care, right?
We answered all the world's questions.
Yeah, this is good. There's no questions.
Giancarlo has a question.
Oh, okay. Did you planted that?
I've got a question for Rich. It sounds like you're talking about the shift from RUGs to RCS and a lot of this, and I'm just interested in your take on the probability that it's going to pass in the state that's currently being proposed.
I think you're going to see it in skilled nursing for sure, skilled nursing facilities. On the home care side, it could be a little longer. I don't think they go at the same time. And so if you're asking me my confidence level, I'm 90+% that skilled nursing are going that direction where you're going to see it be a DRG system, not a RUG system. Home health,
That's interesting.
That's a
it
good
may
one.
not be quite that fast. I think you're a year or two away in skilled nursing.
Annette Becker.
On the home health side, I'm not sure it gets there quick enough. It may be something that's 5 or 7 years down the road.
Really for me?
Yeah.
Yeah.
Does that answer your
I
question?
mean,
No.
Hey, guys, we did receive a poll or a question from the app from Annette Becker. Annette asks,
Should we, okay, Annette, thank you for the question. I think it's directed towards me. There are some challenges and restrictions in getting cash out of China. How will that affect inbound U.S. investment? I think it remains to be seen. It's not clear to me that the media has been covering the ins and outs of the regulatory framework correctly. But I think what is important, if you're thinking about it just at a general level, is where your capital resides today. Is it outside of the jurisdiction of the Chinese jurisdiction? Is it in Hong Kong? Is it in the U.S., Cayman Islands? That's important. I think currency conversion is probably where this is going to bite more. People raising money in local currency, converting it and investing it, that's a no-no. And then also with the sort of investor that you're dealing with. If you're dealing with somebody who's got a sovereign connection through some way, shape, or form, that's going to be a lot, I think, easier to deal with.
could we ever see a senior housing investment made in Bitcoin or some cryptocurrency? No kidding. I mean, this is technology, foreign capital.
It all comes together.
Yeah. What do you
Pay your
think?
rent. Pay your rent and Bitcoin.
Pay your rent in Bitcoin. Yeah, of course.
Maybe. Okay.
Maybe.
All right. Any other questions? Steve Monroe, you got a question back there?
I have a question. Why didn't anybody tell me about the sock program?
Oh, yeah.
Did anybody else notice that?
You don't have exciting socks on.
We can get you.
I get left out.
Come see the Blueprint Suite 1064 and we will get you some exciting socks. I promise you that. We have them.
I totally threw you a meatball there.
That was, we do what we can here. Connor Doherty, anything from you? No? All right, guys. Well, thanks again for coming. Appreciate
Thank you.
your time. Hopefully we learned something today.